So one of the things we run into a lot today, especially with all the popularity over Robinhood and timing and meme stocks and trying to guess what the next Amazon is going to be, is does timing work or does buy and hold work? I really think buy and hold is a good sound principle. But to elaborate on that a little bit further, I don't think that buy and hold, or I always tongue-in-cheek say buy and hope, is a strategy. So it's not just simply pick out a good mix of mutual funds, dump the money in there, and we'll see you in 40 years and let you know how you did. That is not sound. That does not make sense, especially because that environment has changed significantly. Personally, and I really don't like to date myself when I start throwing these numbers around, but when I started, there was approximately 600, I think it was 680 some mutual funds in the market. Now, depending on if you're looking at share classes and how you filter that, it's 13, 14, 15,000, depending on what number you're using. So it isn't like we just also have 1,000 more large cap stock funds or 1,000 more small cap. You get them that are, some of them are doing hedging, some of them are more of a balanced, some of them focus on real estate, so that the landscape is much larger. So to simply say buy and hold what you originally purchased, I think you're going to be disappointed. I do think some time needs to be spent sitting down. Again, what's your risk tolerance? What can you stomach? What's going on in the broader economy? Because here's the tricky thing. Typically, you would want to have more small caps in your portfolio if the economy is coming out of a recession or really starting in an expansive mode. Probably not the greatest place to have a heavy amount of your portfolio in if we're moving into a slowing economy. The changing of the interest rate environment. This is one that is probably a good case in point. So we've been trained over the last 40 years that bonds is a safe haven. Bonds is a very viable asset class, and it should be incorporated into portfolios. But historically, people have said, well, the stock market scares me, so I'm going to run to bonds. And that worked because interest rates for the last 40 plus years were in a downward move. Now we're going to start facing a period of time where it isn't, if they're going to raise interest rates, it's when. And the big question now is it going to be one time? Is it going to be three times? Is it going to be 0.25%, 0.5%? So there's a lot of things we know we don't know that we have to wait to develop. So it's not, well, get out of bonds and let's see where we're going to go from there. But theoretically, you probably should be moving more towards shorter term bonds versus longer term bonds because they're going to be less impacted by the interest rate moves. So if we were just simply saying buy and hold, that would mean stay in long-term bonds and no matter what happens, we'll see where you average. That can be also counterintuitive to a portfolio. So it's really more shifting as the bigger markets, the economy changes. And the great thing for job security for me is every 2 years or 4 years, there's an election. So policy changes. It shifts things as far as what's happening in the economy. And you have to tweak your portfolio to make adjustments for that. And I always tap into some people that I respect, so I use the comment of Warren Buffett. He has kind of a saying that if you wouldn't own a stock for 5 years, don't consider owning it for 5 minutes. This is a great argument over the years because everybody remembers when they win. They remember the success that they've had. They forget the times. Oh yeah, I lost money on that one, but that doesn't count. So have a good strategy. I think it should be more goals-based. What do I need this money to do? And then diversify across the right asset classes and tweak that mix or the ratios between the asset classes depending on what's going on in the bigger economy, the market, so on and so forth.